Hi, my name's Alex, and I'm with Guston Cho Associates. I'm sitting here with Dale, and I'm sitting here with Guston himself. So today we want to talk about cash out refinance, but I first want to start off by talking about what is going on in this crazy economy and housing market, and what's the Fed trying to do. So this is just my opinion, and I think it's a good opinion because I've been doing this for 27 years and I've seen this movie before. So what happened is we went through a pandemic and a lot of money was printed, a lot of money was handed out to people, more money than needed, and rates were kept at an awfully low price. So everybody was buying houses, everybody was buying cars, everybody was buying anything that they get their hands on, spending money, bitcoins, stocks, everything. And then it caused this major inflation in our economy. Probably it's a lot higher than the actual numbers say, because I feel like everything's way higher. Houses gone up 50% in 3 years. So if you look at a chart of a housing to income ratio over the last 80 years, this is the highest it's ever been. And that doesn't even take in consideration the interest rates. So you throw the interest rates in there, and that's just the most unaffordable time ever in history to buy a home. And we're feeling it right now. There's a major slowdown in our economy. We can feel it in the housing market. We're taking the brunt of it. And I think the Fed is trying to undo their mistake of printing so much money and sprinkling it around to try to save the world from COVID when they didn't need to go that far. So now they're trying to fix their own mistake. And I think they can't say this on TV. Maybe it's they can't pinpoint certain asset prices and say we want to attack this, but I think their goal is this, and this is just my opinion, it's not financial advice, is I think they're trying to drop home prices by 20-25%, and then they're going to drop rates. But they also want to see unemployment go up, because this is kind of complicated, but I learned this in college in economics 101, that the perfect unemployment rate is 5%, not 2%, not 0%. And I'm going to tell you why, is because if unemployment is 0%, that means if I want to get a job at McDonald's, and then McDonald's needs me because there's no workers available, zero, and they have to flip burgers and they got no one there to flip the burgers, I can say, pay me $500,000 a year and I'll flip burgers, and they'll say, okay. And that's what causes inflation in salaries. So it's called wage inflation. And that's the worst inflation out there. And we're starting to see that trickle into our economy right now because of the strikes with the car companies. They're asking for 40% raises over the next few years, because just to keep up with the inflation. So what they want to do is they want to kill inflation more than anything. And it sounds horrible, but they want people to lose jobs. They want asset prices to come down, and they want people to reset. Cars are going for 25,000 over asking price. It's insanity. So what they do is that they have to unwind all this. And that's where I'm going to go to. My next thing is, if I am right that they're going to just smash the housing market prices, smash the car prices, smash the food prices, just stop the demand from any people buying, and have everybody spend all that excess savings. It sounds crazy. And then have the unemployment rate go up to a more normalized 5%. There's going to be a lot of pain in our system. And if you feel like you're on that cusp of that pain, and that's coming down the pike for you, and you feel like, my gosh, I don't have any money in the bank, this is why I want to talk about cash out refinances. So cash out refinances is a way to tap into this excessive equity before it might be gone. And I could be wrong, but let's just say I'm right. We have conventional FHA, VA, non-QM cash out options, but I think FHA cash out is the best. Even though you're going to pay 8%, let's say, for your whole mortgage, I think it's going to be a short-lived thing. If rates don't go lower, the federal government's going to go bankrupt because they have to pay interest on their debt. And when they raise rates, that's their credit card. We have $33 trillion in debt that they're paying interest on at the rates that they're raising them to. So they don't want to keep them here either. They'll go bankrupt. So this is a temporary thing. Rates will come down, but I think they're
Alex,
yes.
I'm going to jump in real quick just to add to what you're saying. So, while the housing values are still holding steady, we haven't seen a collapse in values. And obviously, we're seeing a dramatic increase in credit card usage across the country as far as credit card debt per household. I mean, these cash out refinances, even though the interest rates are higher now than they were a couple of years ago, are a great opportunity for someone to consolidate that debt and get it under control. Credit card interest rates are 25 to 30%. They're sky high.
Right. So that's so consolidating debt, putting some dry powder in the keg, so you have some money in your bank account in case something were to go wrong. So you could if you, let's say you don't need it today, let's say that $50,000 you could take out of your house, pay this high rate. I think 6 months to a year. Maybe I'm wrong on that. Who knows how long it's going to take to unwind all this. But let's say you got 100 grand in the bank, cash out of your house. You're paying $300 more in your whole mortgage because you had to refinance the whole thing. You put that in a 6 month or 1 year T-bill and earn 5.5%. So you're losing only a little percentage of it. You could pay off the high credit card debts, yes. But let's say in 6 months, let's say a year, rates drop, which they're going to, they have to. If they don't, we're all, just forget about it. So when they drop rates, you can refinance and put that money that you never spent, if you didn't have to use it, back into your mortgage and do a refinance. Now, here's my concern about a conventional refinance or home equity line, which is a high demand right now. So what happened in 2008 when the houses prices came down, all home equity lines were just cut off. They just shut you down. No matter if you had the 800 credit score or not, they didn't want to lend it at 150,000, 150% loan to value. So they just would turn off these home equity lines. So now that insurance policy you have is no longer there. And with conventional, if you do it and your value drops to a certain level, you're not going to be able to refinance because your loan to value is going to be too high and you have to come up with money to close to refinance. But with FHA or VA, we can do streamlines. Your job, you could be making $1 million a year and you lose your job and you go to McDonald's and you make minimum wage, you could still refinance with FHA or VA because they just want to know that you're working. There's no income verification and there's no appraisal. So you can always put the money that you took out of your house back into your house, streamline refinance with no appraisal, no income verification. You just have to have a job. That's it.
Alex,
go ahead.
Let's talk about like the versatility of FHA and VA cash out refis, like what they offer that maybe some people don't know. Now, you talked about the Streamline, which is a great program in itself, or the VA Earl. But how about somebody who's in a Chapter 13, for example, and they want to buy out of the Chapter 13?
Absolutely.
A lot of people don't even understand that they can do that.
Yep. If you're in a Chapter 13 for 1 year and you've paid everything on time, you can pay off your bankruptcy, do a cash out and get rid of that large Chapter 13 payment. Your trustee will prove it if you're paying it off. So that's a good way to get rid of a large payment that you might have when you're Chapter 13. You might, it might be stretched over 5 years, so you're going to expand it over 30, but you're going to save yourself through these tough times that I think we're all going to see in the next 12 months. So
I'm going to give another example too. On a VA that I recently closed in the last month, I had a gentleman going through a divorce. I actually helped him and his wife, now ex-wife, buy the house. He was going through a divorce. He's a veteran. And the only way he could qualify to get her off the mortgage, because that's what the divorce decree stated he had to do, was to consolidate debt. Well, the VA lets you go up to 90% if you're a veteran out there. And in his case, he had a debt ratio of over 50%. But that's the beauty of the VA. That's very aggressive. You're not going to find that anywhere else out there.
Right. Gus, what do you think?
So if you're in a divorce situation, you're a veteran, or even if you're not a veteran, you can utilize FHA and or VA to refinance the ex-spouse off. And if you have to consolidate debt to qualify, you can do that.
Right. So FHA will go to 80% cash out. Non-QM will go to 80% cash out. FHA conventional non-QM will go to 80%. And then VA will go to 90%. Now, we do offer home equity lines if you want to go down that route, and they go to 90%. They come with pretty high rates at 90%, but we got some people over 90% on that. So we do offer the home equity. I just don't know if they're going to shut it down on you. So if they see a housing market correction, I could see them just turning it off on you, and it's not there for your use anymore. So be careful of the home equity loan. So.
Hey, Alex, I'll add one more thing on the cash out. Like in this current environment that we're in, it seems like I have friends who are remodelers, home improvement guys. It seems like they're looking for more business. They're not that busy. So if you're a homeowner and you've been thinking about doing projects around your house and you've got a lot of equity, you might be able to get, obviously you can use a cash out for home improvement and get yourself a good deal while you're at it, because there's a lot of people looking for business.
And you guys, if you do this, just think it's temporary. If you take this 8% cash out and you rehab your house because you can't move because you don't want to sell your house right now, but it's going to be temporary. So what's happening here is I see the beginning of it happening right now. It's getting very quiet. And if the housing market slows down, it trickles through the furniture stores, the dishwashers, the title agents, the realtors, insurance agents, landscapers, lawnmowers, everything starts trickling through. It's like a snowball, and the snowball is getting bigger and bigger. And once it like goes through and just kind of cleans out the excess, you'll see that even the biggest companies, like even like I'm not even saying names, I don't want to get in trouble, but these big companies will feel the pain. They need the bottom 70% paying for whatever they buy. If they buy one, album or CD or cassette tape or movie, just everybody needs to be buying for the rich people to keep their businesses around. The top 30% cannot keep this economy going. And right now, people are stressed out in the bottom 70%. They're living check to check. Their credit cards are going up. Their student loans are being charged. If they buy a new car, they're paying $1,000 a month when they used to pay $300 a month 4 years ago when they bought a new car. Now a new car is $1,000 a month. It's killing people. I see people make $40,000 a year with $1,000 car payments. This cannot last. So what you saw, what the government's going to do when COVID came and America shut down, they're there to the rescue. They're going to print money. They're going to lower rates. They have to. So you can pretty much count on them doing that again. If they don't, we're all going to be running around standing in bread lines. They're going to fix it. So don't worry about rates not coming back down. Think of this as a temporary thing that you're going to go through, and prepare yourself. Everybody should prepare themselves.
Well, and going back to what you said earlier, it's not a bad idea to take some cash out and dedicate it as a reserve, an emergency reserve.
Right.
If your household expenses are all in $5,000 a month, if you can take out 30,000, that's 6 months. Or if you can take out 60,000, that's 12 months, and just set it aside.
Yeah.
Because if your home value plummets, you'll still have that. You have tapped into that equity for your protection.
Yep. And maybe in a year from now, when everything's happening and you wait, and now your house fell 20%, and now you can't go to 80% loan to value because your value's down, and now you need it, you're not going to be able to get it. So
you're not going to be able to get it.
So, I mean, people who have plenty of money in the bank don't have to think about this. This is for people who saw their house go from a $200,000 value. Now it's worth $500,000. And you got all that equity, but you're living check to check, and your credit cards are getting ahead of you. You're paying 30% interest rate, and you see dire straits coming. Tap into that equity before it's gone. But if you don't need to, don't do it. That would be a bad business decision. This is for people who already feel the pain from this inflation, that they see their money running out, and they're going to start going late on their mortgage. That's the worst you could do. Take money out of your house before that starts happening to you, and pay your bills. Consolidate. It'll help you and get you through this rough patch where the Fed's going to come back and save the day.
Well, you're bringing up a good point about pay your bills. Do what you have to do to pay your bills, fulfill your obligations, because if you fall behind, it's just going to set you back for future opportunities to refinance.
Right. I don't see anybody ask any questions.
Hello?
I think that's pretty much good for me today. Dale, you want to add anything? Gus, do you want to add anything?
Well, the thing is this, a lot of people are concerned, statistics came out that a lot of people, that no time in history are more people late with their car payments, credit card payments. The thing is this, if you're worried about not qualifying for debt to income ratio on a cash out refinance, you have to understand that things that you're going to pay off, like a car, credit cards, they don't count towards your debt to income ratio, because that will be paid off at closing with your proceeds of a cash out refinance, so.
And don't believe what you're seeing on TV out there. They're trying to keep this market propped up. They're not telling the truth. I'm boots on the ground. I handle a lot of the leads for this group, and I see what's coming in, and it went from a lot to almost nothing. It's like crickets are out there. So I think I have a good sense of the demand. We're nationwide. We rank on Google, and there's no demand. In fact, just 4 weeks ago, we would have 25 live people watching us, and there's not a lot of people watching anymore. So the demand for mortgages is gone. And I call the mortgage house purchasing and mortgages like the heartbeat of the economy. It starts so many people buying and selling things. The banks are lending. They're going on the trading market, and they're hedging in the bond market. They're going to mortgage-backed securities, and the banks are making money on every mortgage. The underwriters, the mortgage brokers, the realtors, the title agents, the insurance agents, everything. It's such a big part that when it slows down, the whole economy slows down. There's people out there that they follow this thing called the Hope Network, and the first thing to fall when rates go up, most sensitive, is the homes. Then they see orders start going down for like goods, like a washer and dryer. And then they see profits in corporations go down. And then unemployment's the last. So you're going to see that progression of things slowing down. It's because the housing market's the beginning. And then it starts to go through. And when you start seeing unemployment tick up, which I expect to start seeing that in the first or second quarter of next year, that's when we're all going to be looking around and stunned. So be prepared. I could be wrong, but I've been a bond trader and I've been a mortgage broker concurrently for 27 years. So I've seen this movie, 2008. It was evident to me that we were going through it. We're not going to go through 2008 because people have so much equity, but we are going to go through a price correction. And a lot of people can handle that price correction. So because they got so much equity. So I'm not going to see a bunch of foreclosures unless you lose your job, but we're going to see a price correction. So your equity is going to be gone and you might lose your job. You might be that person on that borderline that's going to be part of it. And the Fed has no good history of doing this exactly the way they want to. What they're trying to do is drop home prices, cause unemployment to go up, and then fix it right there and lock it in. They might start an unemployment snowball effect where it gets out of control. They might start a housing correction to make it out of control. They might do this just perfectly right. Who knows? But that's what they're trying to do. Yes.
Alex, do you believe so? A couple questions here. What will cause the housing correction? Is a job loss recession?
That's a great question, and even the smartest people in the world don't know. This is my speculation. People lose their job, they hang on, they can't make it, they'll sell it because they got so much equity. They're not going to just let it go and foreclose. Now, if you bought the house in the last year, you might be one of those foreclosures because you have no equity right now. You put zero money down in VA, you bought it 6 months ago. That person might go into trouble fast. Now, that's a horrible way to see supply increase. There's a lot of people in the last 4 years became Airbnbers, and you know how hard it is to be a hotel manager. These hotels, people are professionals. These hotels can't keep their hotels booked. So all these people who were borderline thinking, hey, I can make them some extra money, but they didn't have millions of dollars in the bank to back up reserves. They're living check to check, but they bought an Airbnb. It's going to bring them an extra $3,000 profit a month. Well, they don't realize that you need people to go on vacation. And there's so many Airbnbers that are rookies that those might be a source of selling. They say, hey, wait a second, my Airbnb's not being filled up anymore. And I'm starting to hear people who did this that are friends of mine, and they're saying, yeah, there's no demand anymore. I get a one-off here and there because there's so much supply of Airbnbs. If you look at a Florida heat map of Broward County, which is Southeast Florida, there's 5,000, there's like 50 houses for sale in this 20 mile square area. And there's 5,000 Airbnbs right now listed for rent. 50 homes for sale, 5,000 Airbnbs for rent. It just shows you that there's not enough demand anymore. And that could take down, that could increase the supply issue. Another one is the builders. They're not going to make a big dent. And the fourth one, which I would like to see the most, because I feel like these people they destroyed our economy. These big companies, I'm not going to name them, a lot of them bought up properties after property with cash, and they sold it as investment vehicles. And these investment vehicles, the people who bought them didn't read the fine print. They can't get out. They see the housing market correction coming, and they want to get out of this, and they're locked into it. These people
it's a REIT, right? It's real estate investment trust.
They bought single family homes from the consumers. There was no supply for the consumers because these people were paying over asking. They were paying with cash, and they were beating out the average homeowner who wanted to get a mortgage, and they just bought all the properties up. There's plenty of homes. We did not have a population boom in the last 4 years. We did not have an extent. Everybody was living in some house, and all of a sudden they printed money, and now there's no houses. There wasn't a population boom. It was everybody wanted to buy a house as an investor, as a third, fourth, fifth, or 10,000th home. If you're one of these big companies, they were buying everything they could find, and they're turning into renters, and they're jacking up people's rent, and they're crushing the poor. They need to be punished. They need to sell those houses and flush the market out and let the consumer. There should be a law, in my opinion, against these people. But that's where I think the supply
Alex,
should come from.
I want to throw something in there. This isn't really specific to Cash Out, but it does pertain to what you're talking about. I mean, people ask me all the time, how's your business, whatever. Yeah, I go, rates are up, things, it's tougher right now. But for the renters out there, you talk about payment shock. A landlord can come out of left field and push your rent up $500 a month, and there's nothing you can do about it.
Yeah.
There's nothing you can do about it. And so
Right.
as bad as it may seem rate wise, it's worse for renters.
Yep.
Exactly. Because I'm going to tell you, on these apartment complexes, commercial deals, there's, there's no such thing as a 25, 30-year fixed rate. All right. So it's usually balloons after 3 years, 5 years, or 7 years. So what happens is when the mortgage balloons for these apartment complex owners is it'll go from 3% to 7% on an adjustable, maybe higher. So that's going to trickle down to the renters. So the thing is when this is a trickle effect, so it's gonna exactly what you said, Dale. So when the lease comes out, the new lease,
Hey,
they can jack it up by 20, 30,
yeah, it's
40%, even
payment
50%.
shock. They
Yeah.
can't handle that. Yeah.
So
You know.
that brings up a good point of what's also going to hurt the economy with these high rates. So office buildings, they do 3, 5, 7-year arms max. Most of them are 5-year arms. And with everybody working from home now, the office vacancy has gone way up. There's 50% owner or renters in a building that used to be 80% occupied or 90% occupied. And that person bought that building with that cash flow in mind at 3% interest rate 4 years ago. And now the renters are gone because they're working from home. So no one's renewing their office lease. So they got less income. And now their rates are going to reset to a higher rate. And the banks are carrying these notes. And when they go to refinance, they're going to say, the banks will say, I'm not going to refinance you. And these banks are going to have to take these commercial properties, these office buildings from people. And that's going to cause a lot of banks not wanting to lend.
Well,
It's gonna
Alex,
cause-
you
Yeah.
talked about you talk about the chain of events that could lead to eventually lower rates, job loss,
Right,
recession. Do
right.
you believe we're going to have a tidal wave of foreclosures in the commercial industry because of all the adjustable rate
Yes.
mortgages they're on?
Yeah, yes. I don't think we're going to have a tidal wave in residential, but in commercial office space, I think there's going to be a lot.
Yeah.
I don't think residential commercial is going to be a problem. People have to live, but these office buildings don't have the revenue stream anymore. They don't. I can see it in my own building. There's the parking lot's empty. I used to have to park in the back lot and walk all the way in the rain. Now I get a spot right next to the front door. So
Yeah.
I can see it where I'm working.
Yeah. Commercial
hearing
space
it.
is,
And I'm hearing it.
there's a lot of vacant commercial space.
These so just so you know, the banks are in major trouble. So let me explain something about why another thing that's going to break, that's going to cause rates to get better. So this is really hard to understand for a lot of people. When you go deposit 100 grand in your bank account, the bank doesn't put it in a safe that you go back and pick it up. They invest it. They're forced to invest it. They want to get a return on their money. And a certain percentage has to go towards treasury bonds or mortgage-backed securities, or they make loans to a commercial property. So they're always lending your money, making money on your money. So you give them money, they're lending it out. And right now, the people who, when all this money was printed, all this money went into these banks' depositories, right? And then they had to turn around, they bought mortgage-backed securities at 2.5%, or they bought 10-year treasuries at 1%. And now they're at 5%. These treasuries, what that means is that the position that these people have, a 10-year treasury they bought at 1%, now it's at 5%. That means they've lost a big chunk of their principal. So that's the complicated part. When rates go up, the value of the bond that they bought goes down. So they don't have to what's called market to market today. And what happened is when the banks almost went bankrupt in March of last year, the Fed came in and gave them facility to let them treat that bond at par. They borrowed the money for a year, and come this March, those loans are due. So they're up. I mean, if you look at Bank of America's earnings that came out, they have 113 billion in losses on their balance sheet, and they got 200 billion, or they got 150 billion in assets. So they're negative 50 billion on their balance sheet if the rates don't get good. And the Fed represents the banks. So the Fed's not going to let them all go bankrupt. So they're probably telling them on the side, don't worry, we're going to drop rates in a year. We'll get you to that. So that's another sign that there's a lot of stress in the banking system. The commercial paper for the office space is a big stress on the system. The consumers that can't afford goods anymore, the cost of homes, the rates, the cars, they're trying to break it and find where the weak spots are, and then they're going to fix it with a big Band-Aid. And we're just waiting for that event.
Alex, do you believe the Fed is trying to break it, or are they looking for a soft landing?
They're looking for a soft landing, but they know that they can't create that. It's going to be very difficult for them to do it. And if you watch Powell about 3 weeks ago, he's no longer saying a soft landing is his base case. He said that. So that's not, they've never done a soft landing. I watched a lot of YouTube videos and they showed every crash from like since the 1900s till today. And they showed each recession and each housing or each market crash. And they showed the newspaper from like a month before and said soft landing. So they're always saying soft landing. They're always saying words like green shoots. They're always saying things are good. The markets always look the best right before the big crash. I'm a student of this stuff. Now, can they pull it off? Maybe. Are likely? No. The odds are very against them for pulling this off. They're not. It's not likely because of all these stresses in the system. But if they were to, the worst thing they can do is turn around and say we give up because everybody's starving right now because they can't handle inflation. If they just drop rates to 3% tomorrow, yeah, we'd be busy for 6 months to 12 months. But the price of homes would even go farther out of reach for the bottom 70%. We would have an inflation in a housing market that would create the rich. Only the rich could live. And it would be kings and queens and peasants in the United States, and that's not what they want. So that's the danger of us. We have to suffer through a rough patch in this economy. We do. It happens all the time. 2000, there was a big crash, flushed out, it gets reset. That was the dot-com bubble. 2008, it was a housing bubble. Right now, we got an everything bubble. You know, everything's out of control. I mean, the whole world's a mess. So here's another thing: the whole world's having this problem. When in 2008, it was just us having that problem. So this is a bigger issue when the whole world is feeling exactly the same problem we're all feeling.
I'll tell you a good little litmus test, or, you know, no matter where you live, you know, like I walk around in my neighborhood a lot, and there's a couple houses that are up for sale right now. And one of the economists that I like to listen to says, when you see houses go under contract, like in, let's say, less than like around 15 days, he calls it teenage years. He said that's a sign of an unhealthy housing market. You start to see houses go under contract in 30 to 45 days. That's an indication that the housing market is cooling down.
Right.
So I have one down the street from me that's been on the market for about 3 weeks, and I don't see it under contract yet. So I don't know. What do you think about that, Alex?
I mean, look, I don't know what this is going to look like, but yeah, the law. We want to see a healthy 60-day houses sitting on the market.
Yes.
60, if you're seeing the last 10 days, that's too fast. If they're a year, that's too long. So there's a perfect balance. I think they want, like, 60 days on the market is a nice balance. Maybe 90 days. So that gives buyers and sellers a chance to find a real equilibrium and not. And right now, first and foremost, we need prices to correct. It's just simple math. If you make $60,000 a year and you're at 3% interest rate, you could probably buy a $300,000 house. There's no 300,000. If you make right now, 60 grand will get you about $180,000 house. There are no houses for 180,000. So
I heard the average home price across the country is over 400,000 right now.
Right, and the average salary for American is 60 grand. So that's out of whack.
It doesn't equate, right?
Yeah, if you look at just incomes from in 2000 till now, and you look at home prices to now, income went up like 12%, and the house prices have quadrupled. So wages have not kept up with the house prices inflation. And it hasn't kept up with anything, any of the inflation, all the
Alex,
inflation.
are we in a stagflation environment?
We could
stagnant wages and rampant inflation.
Right now, we still have growth. Today, the GDP was 5%, but I think we're going into a possible stagflation. But let me explain. So back in the 70s, it used to be the one man in the household would make enough money to take care of his whole family and retire on it, have $1 million. Now you need two people just to pay the bills, and now that's not enough. You need mom and dad have to work now. Now the kid's got to go work at McDonald's when he turns 16 and pay for his own car. It's really bad what's happened with inflation over the last 50 years here. And we just keep printing money and causing more inflation. And right now we're at a very big important point in our America to even have other countries to want to even look at us as real people anymore. Because if we print another $30 trillion, we just made some small country in the South America go broke because they're paying in dollars for their oil. And every time we print money, the cost of oil goes way up for them. It goes way up for them. And pretty soon the world's going to say, get out of here. You guys are just printing money. If printing money it doesn't hurt. Why don't we just print $100 trillion right now and sprinkle it around? It crushes the rest of the world, and it crushes the poor people in America. So you can't just print money. That's not the answer. And the fact that we're $33 trillion in debt right now as a nation is a big problem, major problem. So that's why this recession could be extra worse. So, well, there are some questions here. They want to refinance 3 mobile homes that are in a parcel. So we cannot do mobile homes unless it's attached to the ground and you own the land. So keep that in mind. We cannot do any mobile homes unless it's turned into what's called a manufactured home, where they take the mobile home and they permanently affix it to the ground. You own the land, it's taxed as real property, and you got to get an engineer's report to make sure that that thing was affixed to the ground right. It kind of makes it like a regular home. And so we can't do any mobile home cash outs. Someone wants to refinance and consolidate that. Oh, that was the same question. Are there any second lien products for cashing out that is fixed rate? Not a chance I'm giving up my 2%. Yeah, so we got the home equity lines we can do. So if you want to give us a call with a home equity line, we can do that.
No, if they want a fixed rate, can you get a fixed rate on a home equity line?
Yes, we can. We have a closed second.
So a closed second, right?
Yep.
I think you can go up to 90% on those in some cases.
It's a very high rate, and we do bank statement loans on those too.
Yes. Yeah, we will do a bank statement second. That's a good point.
LTV is based on the credit scores too.
Yeah,
you
so
need
there's
a credit card.
So there's someone who said they filed a Chapter 13 last July. If last July means 4 or 5 months ago, you have to wait 12 months and you can't do it. If it was a year and a half ago, you were eligible for it, but everything in your life has to be perfect. So if everything's been perfect, meaning your bankruptcy payments, your mortgage payment, your credit on that you kept outside of the bankruptcy, then we could do a cash out, pay off your bankruptcy and pay off some more stuff if you have enough equity. So remember, you have to be in the bankruptcy for at least 12 months before you're eligible. And remember, don't be late on anything.
You cannot be late on anything in the last 12 months.
No. At FHA, you can't be late on anything since you filed the bankruptcy till today. So if you're in the bankruptcy for 3 years, no lates on anything. They'll disqualify you.
Yeah, post bankruptcy, correct.
Yep. All right. I think that wraps up for today. You guys agree? Good.
Yeah.
All right, hey, you guys out there, please subscribe, please like, please hit the bell. Please, it helps us help you guys. And if you got any questions, we'll try to answer them on YouTube. Give us a call. Our phone number's all over the site. Give us a call. We do loans down to 500 credit score. We do tough loans. We do non-QM, FHA, VA, USDA, conventional. We do it all. Hard money, commercial. Give us a call. Thank you very much.
Thank you.